So this week, I wanted to focus on some of the industry's standards when it comes to trading options, because there are quite a few go-tos that once you kind of get those under your belt, you got this idea of things that you really don't want to do. And then on the other side of that, there are quite a bit of things that you want to have as your go-to that you kind of always want to do. So a little recap of things we've already covered. We've done things like why we would want to buy a call, why we would want to buy a put. We've covered things like directional trading, non-directional trading, intrinsic value, unusual options, options volume, the bid, the ask, the analysis tab. We've gone through quite a bit of material, and the goal would be that you go back and review those things from time to time until it becomes a normal, familiar thing. A lot of options confusion comes down to the language in the options market. It's not because it's necessarily difficult. It's more of the idea that it's just different. It's a different kind of language, and words like margin and intrinsic value and things like that, they just kind of throw people off. So, when you get to the point where a lot of this language becomes normal, then you get to the point where you're focused more on the trade that you're trying to take rather than the construction of the trade that you're building. So let's get into some of those do's and don'ts this week, some of the common knowledge behind options trading. Options have a PDT. They are regulated by the same body that regulates the stock market. And if you're kind of new to trading all around, you may not realize it, but the stock market is governed by different parts of our government. So futures are governed completely differently than stocks are governed, and options are ran by the same body that runs the stock market. So options are only tradable while the market is open. Now I'm going to add something to that I didn't put in the book, and that is when you see the numbers changing in the options tab and the market's not open, you want to be very careful about the numbers that you're seeing. So if you go in, after the market is closed, or you're in there at like 9 o'clock in the morning and you're looking at these values, they're not real. They're not accurate either. And the danger is that if you try to place trades before the open, you could get filled at really bad prices in really bad locations. You don't want to trust any analysis that you do either when the market is closed. And the main reason for that is the broker platform, at least Thinkorswim specifically, it's going to look at the bid and the ask, and then it's going to look at the mark. Well, when the options market is closed, a lot of times these numbers get real wide, and then that mark is really off. So the pricing is nowhere near where it should be. And then when the market moves in the overnight hours, at the money is no longer at the money. It may not reflect the real at the money value. So you never want to try to go in and build a trade before the market opens and then submit that into the queue before the bell, thinking, well, I'm going to catch it right when the bell rings. It's a real bad idea. So just add that to the list of things you wouldn't want to do. But back to the book, there is PDT when it comes to trading options, and it's the same PDT rules that we would have trading stock. And that means if you're running in a cash account, you don't have to worry about PDT. But of course, there's a little asterisk connected to that because some brokers will develop their own rules. And what the government says to the brokers is, if your rules are more strict than our rules, then we'll let your rules rule. How you like that? That's a lot of the word rule in a row. So the government is odd when it comes to things like that. They do that kind of little asterisks in a lot of things: construction, building materials, safety. Same thing in options. If a broker has rules designed to protect you and the government thinks that the broker's rules are better, then that's what applies. So you can run into a broker who won't give you access to a cash account without PDT. You know, it's really, it's up to them. So when it comes to PDT, trying to cheat the system is not always a really good idea. It can be done. You can open up multiple trading accounts. You can, you know, stay in cash. Any way that you would avoid PDT in stocks, you can avoid it in options. Same thing with round trip. So avoiding round trip, if you can just hang on to the trade until tomorrow and then close it, you'll avoid the PDT. Rules to close is another one. Newer traders usually have this idea that they want to hold it into the close so that they can maximize the amount of money that they can get for the trade. Now, after you've been around for a while, you start to realize that's a really bad idea. And the amount of money that you're going to get for holding it those last 20 minutes of the day often isn't worth the risk that you're taking. Some brokers charge a fee if they have to exercise your trade after the close. So if you have an option in the money, on Thinkorswim, it's $15 per leg that's in the money. So you may be trying to avoid, you know, a $7 loss and end up with a $30 fee because you didn't close the trade. So kind of give that some thought. Another thing is, and this happened twice last year that I know of. The market closes at 4, but on expiration day, options can be exercised until 5:30 at night. And so the danger is, you know, it's Friday afternoon, you see that your options trade is out of the money and you hold it into the close, you shut down your system and you go away for the weekend. Well, what happens if, suppose you're in a put spread and you're out of the money and the market falls and puts your put spread into the money, but only half of your put spread. So now you've got a short leg in the money and the person who has the other side of that trade exercises it. Now you're in a spread, so you're supposed to be safe. Except if you don't realize that they exercised you, your long will disappear like it's supposed to. And now you're assigned and exercised on the one that was in the money. You come back on Monday and you're now down thousands and thousands and thousands of dollars when you were in a trade that was supposed to have defined risk that wasn't going to allow you to lose more than a few $100s. That happened to someone with Tesla last year, and they had 5 lot, $1 wide Tesla. Half of the trade was assigned. They didn't know it. It happened at like 4:45, 5 o'clock at night. And they were down $30,000 Monday when they came back. You imagine the gut punch that person felt, right? And there's absolutely nothing they could do about it. What's done is done. They couldn't go back and undo it. And yet the easiest thing in the world to avoid that situation is just to close the trade down by the end of the day on the day of expiration. And the closer you get to the end of the day, the harder it is to get that trade closed. Keep in mind, if your trade is very, very far out of the money and it has zero value and you can't get filled and there's just nothing that you can do to get out of it, that's a completely different discussion. We're talking about having a good trade anywhere in a reasonable area where you don't have a lot of bag holders. Now, if you're new to options trading, you may find it difficult to see bag holders, but here's Citigroup. And you can see that all these options down here, these are all just trapped bag holders who are hoping to maybe eventually get out of this junk. It's very unlikely that these are going to manage to any kind of profit unless the market rallies back up exponentially, right? Because it's only got a $2.50 move between now and the next 10 days, and we're looking at something $10 out of the money. So if your trade is sitting way out here and you're going into the close and you can't get filled, it's okay. You're probably not going to have an issue. And you may find it really hard to get a spread filled because the spread has a long and a short. And that means you have to find somebody willing to buy your trade minutes before the close. Who's going to do that? Nobody. Now you can break that trade in half and close just the short side, which would be you buying something as you go into the close, because you would be buying to close half that trade. And what you will find is everybody and their cousin's brother's uncle is willing to sell you something going into the close. They may not be willing to buy it from you, but they'll certainly sell it to you. So if you really want the trade closed and it's going into expiration, close the short side. You're in control of the long side anyways. You can choose on your own not to exercise, right? Because the buyer has rights. But don't play chicken with the market. Don't wait until the last minute to try to get out. Don't hold them into the close, especially if you're anywhere near the money. And depending on the broker you use, there is something called an MOC. And that says no matter what the cost, we will get this trade closed by the end of the day. So, depending on your broker, you can do something like that. Not all brokers have an MOC, by the way. So that kind of sucks, but there it is. All right, closing with profit. Now, this is something when I was newer to trading that I really got hung up on. I wanted to have a good idea of where to close this trade. There's this industry standard that we hear a lot by a big name firm, Tasty Trades, Options Alpha. There's a lot of places out there that talk about closing the trade at a defined profit target. And that's mainly when they're dealing with a trade that actually has a defined profit ratio, right? Now, what do I mean by that? If I buy a call, it has unlimited profit. As long as the market keeps going up, this call will keep making value. It doesn't top out or cap out along the way. But if I put on a call debit spread, there's only so much money this thing can make. And when I get to the ceiling, that's all I'm going to get. So that's a defined profit trade. Debit spreads and credit spreads with that defined profit are often talked about in the marketplace with a defined profit target, something like 25%, 50%, 75%. And the go-to number bandied about most of the time in public is, well, we should be closing at near or around 50% profit. I don't necessarily agree with that just as a blind general statement. And the reason why should kind of be obvious, but we'll kind of think it through. Suppose, for an example, that I get into a put spread down here. And the idea behind that entry is, gee, I think we can go back up to the top of this range. And that's all I'm really thinking that the market's going to do. So I get into the trade, and the very next day, it explodes way past the place I thought we were going, and it just continues to go higher. Now, as long as it stays above my break even, I'm in a winning trade, but I'm also in such a comfortably winning trade, I really don't have any reason to close this out unless I need the money, right? When you're dealing in a small account, sometimes you can't open a new trade until you get one closed. So if I need the money, sure, go ahead and close it. But if I don't need the money, why would I arbitrarily decide to stick to some profit target rule when my break even is way down here and I am so very far away from any kind of risk? The market would have to come back down, break through that support level, break the next support level, and then finally get to me. I'm feeling pretty confident about that trade. I don't want to just randomly close it down and give away profit for nothing, right? So kind of keep in mind when you're dealing with these trades and the target profits, they're not an absolute science. Another thing when it comes to target profits is consider what your overall aggregate risk is. If 3 out of 4 stocks mimic the market, that means they're all moving with SPY. And in SPY crashes, 3 out of 4 stocks are going to crash, which means 3 out of 4 of your long trades are going to crash. So if you're holding a lot of long positions, whether they're calls, put credit spreads, whatever it is that you're holding, if you're holding a lot of long trades and you're feeling like you're long heavy in the market and you're finding it difficult to sleep at night because you're just sitting there kind of worried and upset about all this risk you're holding, maybe it's time to close down some trades, even if they're not at 50%, right? You just want to go in and start maybe cleaning house, getting rid of some of the more riskier positions or the bigger positions that you're holding. So I've never been really comfortable with this arbitrary rule of just closing trades down because they got to a target percentage. Put a little bit of your own input in there. Is there really risk? Are you holding too much risk? Another thing when it comes to target profits is that when we close early, we increase our win rate. Now, increasing your win rate has a lot to do with like tuning a knob on a radio, trying to dial in a radio. So when we're doing really good in options trades, we want to reach higher in our target profits. We want to try to get more money. But when the market is choppy, disorganized, it's going long and short and long and short, and it's kind of just ripping everybody up, you're going to want to try to close a lot of those trades down earlier to avoid getting chewed up, right? You won't make as much money per trade, but you will win more often. So it shouldn't be some fixed finite number that never changes. You should be willing and perfectly comfortable with going in and adjusting that target profit percent. And having some clear rules along the way for when you want to do it is going to help out a lot. Now, the problem is when it comes to those clear rules is newer traders don't often know where they should even start building the rules. And then the idea that we can or should change them. So one way I like to approach this is kind of doing it in percentage zones. If I'm building a new strategy, or if I'm dealing with a market that has recently been giving me a lot of grief, changing directions, lots of spikes, more volatility than normal, I will close earlier in a profit zone somewhere between 15 and 25% profit. And it's not some magic number. It's just that hitting 15 to 25% profit often means you're closing a trade in just a few days. So you're rotating in and out of that market, dealing or giving them your portfolio time to deal with the market that you're in. Once I've been running a strategy for a while and I know it's working really good, I will spread that out a little bit and start moving from 15 to 25 into something more like a 35, 55. And that's just my normal go-to, well, it made 50%, let me go ahead and close it down kind of position. But again, if the market made some exaggerated move and I'm not feeling the risk, I really don't see any reason to close it down. And I'm going to start aiming for what I call a duration profit zone, going in for the long haul and holding it between 65 and 80%. Now, TD Ameritrade has a lot of webinars. There's this wonderful woman who does their small account webinars, and she targets an 80% target profit. And it doesn't even matter to her, you know, if it's a small account, a big account, she doesn't care. Her name is Barbara, if you want to go find her videos and watch them. But she aims for an 80%. So it's not even, you know, like my own bias of saying, oh yeah, I do an 80%. Well, I'm not the only one, you know. I may disagree with a lot of what TD Ameritrade does, but you can't disagree with, you know, their education and their background. They got years and years and years of experience. Their webinars are made by actual traders, not just Bob sitting in grandma's basement. So you should give some real thought to how you want to manage your trades, and keep in mind that it should change depending on the kind of market you're dealing with. It should not just be this rubber stamp answer to everything that I'm going to close it down at 30% all the time, forever and ever. Amen. And by the way, on this one, asking somebody else where you should close your trade is kind of like asking somebody else to manage your money. Every time somebody asks me this question, I always want to respond with, can I have your wallet? Seriously, just give me your wallet, give me your money. Let me have control of it. I'll tell you when you can buy something. I will dole you out an allowance, and I will let you know when it's time to do anything with your money. And if you are sitting there kind of hearing me say that and thinking, screw you, man, I'm not giving you my money. Good. That's good. And you should also be saying the same thing about where to take profit. Don't let me tell you where to take profit. I may be a risk taker. I may decide, let's go to Vegas, baby. You hold that thing all the way to expiration. Doesn't matter to me. It's not my money. It should matter to you because it is your money. So speaking of risk, there's a common phrase in the market: trade small, trade often. This gets kind of twisted around. They're not implying that every trade that you put on should be in small width. They're implying that your risk should be small. Now that can get kind of arbitrary, because if you've got a $100,000 account and I've got a $1,000 account, what you think is small and what I think is small are going to be completely different. But you want to keep your risk small, and you want to put a lot of trades on, because options really are the law of averages. If you're running options positions that statistically have a 65 to 75% win rate, you need the law of averages to get that win rate. One trade isn't going to get you there. One a month isn't going to get you there. You need at least one a week, preferably one every other day. You want to keep rotating that capital, putting on as many trades as you can get. Diversification is a real big deal too. So if you can go long and short, that's the best diversification you can get. But also think about diversifying what you trade, so that you're getting into different sectors and different industries and sub-industries. When it comes to trading small, here's a real good example of what trading small looks like. We put this Tesla trade on today. Look at how wide the trade is. All right, I got the 880 1000 spread. It's 120 points wide. It's kind of big. It's a really wide trade. I'm only risking $178. Now, depending on your account size, you may be thinking, gosh, that's a lot of risk. Or you may be thinking, what, you only took one? I would have took like 10 of those. Damn, risk is unique to each person. To me, this is all the risk that I wanted to take. About $175 is my sweet spot. I don't want any more than that. I've got a lot of trades on. And yet, look at the width of the spread. It's a very wide spread. So trade small, trade often. Now, this is just one account that we're looking at. And I've got multiple accounts and multiple trades on. So the risk in aggregate, it adds up. When it comes to thinking about account sizes, there really is no sweet spot. I've heard numbers bandied about by some pretty good sized names. Options Alpha, for an example, says that a quote small account is somewhere between $3,000 to $5,000. I don't know. I don't think I necessarily agree with that statement, because that would mean anything less than that would be considered like a micro account. Either way, you do want to recognize that if you're starting out in a very small account, per trade, you're using a large chunk of your overall aggregate capital. So there is this other thing in the market that says you shouldn't use more than, say, 3% of your entire account per trade. That's impossible with like a $300 account or a $500 account, or maybe even $1,000 account, right? How can you put on a trade where you're literally risking only 3 pennies or 5 pennies? So you can see that those kind of numbers statistically just don't work. You don't want to use the bulk of your account. That's for sure. And it comes back to the 3 out of 4 rule. Back when the virus hit, for an example, everything fell. Now, there's always this discussion about, offensive markets and defensive markets, and how, quote, safe money will go to utilities and gold and real estate, precious metals. And they will do that in times of uncertainty and crisis. But we saw back here, everything fell. Everything fell. There was no safe markets. There were no defensive markets. There was nowhere to hide. Everything fell. And it would not have mattered how diverse your portfolio was when it comes to allocation into different sectors or industries or even sub-industries. Everything fell. The only diversification that would have helped in that situation was any trades that were on short. So having shorts and longs in your account. If the bulk of your trading account is in long positions, or especially just in options, then the bulk of your account is at risk if we have another event. And there will always be another event. It may not be, the Delta. It may not be the coronavirus. I think the last time it was an airport project in Mexico. That was the 2018 sell-off. And then before that, it was a temper tantrum or a taper tantrum in the market. And before that, it was a cash crisis between the yuan and the dollar. You see how it's always something different. Before that, it was the '08 crisis. There was Brexit. There was the Trump election. There's always something. And we're never going to be able to see it coming. So don't put the bulk of your entire trading account into the marketplace, especially the options marketplace, because these aren't objects like owning stock. If you own stock and the market crashes, you still own that stock. It may not be worth as much, but it's still yours. You own it. With these, you're just borrowing. You're just on loan. So, kind of keep those things in mind. Always keep some of your reserve sitting on the sidelines so that you can put it to work if you need to. Sometimes we can roll trades out, give them more life, give them more time. And oftentimes that's just what they need, is just another week or two. But it takes capital to do that. We have to have the amount of liquidity to go in and buy that extra time. And if you've already allocated all of your account or the bulk of your account to trades, you won't have any capital left to adjust the losing position. Another go-to is that put credit spreads can be rolled if you're losing. I did this quite a bit in 2020. If you're in a put spread and the trade is losing, you can often get a roll and get paid to roll it if you just wait for a green day or multiple green days in a row. So that's something to keep in mind. Let's see, we talked about diversifications, hedging. Don't let hedging kind of freak you out. There's a lot of talk about hedging, and it always seems to be this strange, complex, kind of shady discussion about how we can protect our accounts. Hedging doesn't need to be complicated, and it doesn't have to be in SPY. if you're in a trade in Amazon, you can hedge just by buying a put in Amazon. Anything can have a hedge, and all the hedge is really designed to do is protect you a little bit. It will never cover all of your risk, or it shouldn't, because then it's actually so big it becomes its own risk. There's a lot of ways to hedge. It's worth learning, especially in its own thing. Just going out and learning what hedges are, learning how to apply them, even doing something inverse, using the inverse ETFs can be designed as a hedge. So keep in mind that, quote, hedging is a good thing, but they are designed to be cost. They're supposed to lose. And I know a lot of people balk at the idea of putting on a trade that you know is going to lose. I mean, I get it. You might as well just pull money out of your pocket and set it on fire. But it's supposed to lose. We don't want the hedge to win. And that means we're paying for something that we deliberately know is going to lose. And that's hard to choke on. It's think of it like your house insurance. You really don't want your house insurance company to give you money, because that would mean something is really bad at your house that needs fixed. I have house insurance for fire. I really don't want my money back. So I pay my house insurance hoping that I never get my money, because I don't want my house to burn down. A hedge is exactly like that. It's like fire insurance. You don't want the money back, but you definitely should be willing to pay it. So earlier I talked about how to increase our win rate. There are some known go-tos when it comes to increasing our wins. And this is always a fun subject for me because I love just the whole idea of it. Make me a better me, give me an opportunity to win more. How can I do that? Because I want to do that. Funny enough, the things that it takes to win more aren't necessarily connected directly to options trading. We can win more often if we avoid risky situations. And I get it. Every time somebody points out this crazy parabolic market that has like literally gone to the moon, and they ask, is this tradable? I mean, I want in just as much as they do, but I just don't do it because it's a risky situation. I want to avoid risky situations. Trading earnings, trading near an earnings, trading when a market has news, trading within a dividend payout, trading a gapped market, a parabolic market, and trading options that are not liquid enough are all risky situations. And if you avoid doing those things, just those things right there, you will increase your win rate. Just immediately, you will not lose as often if you do those things right there. But nothing is free, and there's always consequences. If you do things off that list, you're going to miss out on a trade. There will be times where you say, well, no, that's risky. I'm not doing it. And it turns out that it would have worked. And that's going to make you second guess and say, that's a stupid rule. I don't know why I have that rule. Look at how much money I missed. I could have made a fortune. Yeah, well, that one time, sure. But what about the next time? So I used Sam here for an example. And this is actually an example because somebody had brought it to me and said, hey, can you identify a trade on Sam? I really want to take a trade here. It had already gapped down and it had already broke structure and was headed lower. And they wanted to trade it back up. If you're in here, I'm not picking on you. You know who you are. But this is a great example. So, of course, my answer was, I wouldn't do it. If you want to do it with your money, I guess, but it's a real bad idea. It's a market that's gapped down. It just had earnings. And oh, by the way, it doesn't even have weekly options. So I don't know if the person took the trade or not, but this calls to us, right? We see something like this and it's, oh yeah, I mean, gosh, I want to trade that. No, maybe I don't. It's a really bad idea. If you don't trade things like this, you will win more often. As an example of things that don't have weekly options, here's an example of things that does have weekly options. And I don't think every broker does this, but a lot of the bigger ones do. They'll actually have the word weekly next to it so that it does have weekly options. Funny enough, a company doesn't just get weekly options. It's not something that they choose to have or choose to not have. A company has to earn the right to have weekly options. And it's decided by the industry. I don't know what the criteria is, but if it doesn't have weeklies, it's like a big neon sign that says this company has so illiquid options that it hasn't even earned the right to have weeklies. And that should get your attention. And maybe you don't want to trade that. So a little bit of a checklist that you can use before you go to get into a trade can really carry you a long ways. When I was newer to trading, I would forget to check to see if there's earnings. I know how silly that may sound if you've been trading for a long time. Like, well, how can you forget to check that? I was new. I would forget. There was so many other things that I was focused on, like what's the Greeks doing and how far can this thing move and how much volatility. I would forget all about dividend or earnings. And then I would get into the trade, and 3 days later, I'd realize, oh, shoot, man, they got earnings next week. Dang it. Now I got to get out of this. So that checklist can be a real lifesaver. And the more time you spend trading options, you'll get to the point where you don't need the list anymore. And maybe you'll grow the list out more than what I have here. Because there are things that you may decide make things risky, like maybe companies that are less than $10. Trading those would be risky. Trading markets that don't have a lot of stock liquidity is risky. There's all kinds of things you can put on this list, but actually having a checklist is a good piece of business, especially when you're new. Now, I have heard people say, and I love the phrase every time I hear it, and it's always a new options trader. I heard trading options are risky. I don't know if I want to do that because, man, I heard they're risky. Yeah, trading, just trading is risky. But we're absolutely in control of the amount of risk that we take, whether we're trading futures, stocks, options, it really doesn't matter. The real risk to trading in options when it comes to quote risky is trading while we don't understand what we're really getting into, what the ask is, or what we need from the trade to be successful. That's risky. So if we don't do that, we can increase our win rate too. That's what I got, guys. I tried to keep it short and sweet. This is a spot for questions, though, if I covered anything and you got questions on what we went over. I'm still waiting for the wallets, by the way. I mean, you guys can give me your wallet. No? No takers? You guys are no fun. It's in the mail. I love it. That's a good one. So that's it, guys. Introduction to options, as usual. It's not meant to be, in depth. It's general exposure to the options world. Every time we do it, you gain a little bit more. Like it's just osmosis. It's just seeping into your pores. It gives you something to think about. There's no wrong way to do business when it comes to the option world. You can be as risky as you want. You can gamble. You can do the craziest stuff because it's your money. You can do whatever you want. So give us some real thought into the things that we've gone through. And I really encourage you to go back and start the book over from the beginning. Every time I reread or rewatch something, I get a little more out of it than the first time. And I bet it would be the same way here. So if there's no more questions, I'm going to cut the stream, keep the video short, and I will see all of you tomorrow because I'll be live streaming in the Bullish Bears.